All right, the first stock I'm going to highlight is IBM. And what you're looking at here is my proprietary discounted cash flow valuation model for IBM stock. I forecasted all of the free cash flow I expect this business will generate between today and the very, very long run. And I've discounted those cash flows. I've calculated a weighted average cost of capital, and I've created an intrinsic value per share where I believe it's a fair value to purchase IBM stock. The next AI stock I'm going to recommend and rate as being cheap is Alphabet. I did a very similar calculation with Alphabet using my proprietary discounted cash flow valuation model, and the weighted average cost of capital I calculated for Alphabet is 9.71%, higher than IBM, and that's understandable. Alphabet is less established. Alphabet's free cash flow is more volatile than IBM's free cash flow, and the stock price is more volatile than IBM's stock price. So those are the factors contributing to a higher weighted average cost of capital for Alphabet. Still, I calculated an intrinsic value per share of $231 for Alphabet. The current market price is $192. Now, the forward price to earnings ratio for Google is surprisingly lower than IBM. It's trading at a forward PE of 20. And I've been talking extensively about how Alphabet stock is undervalued, and I've rated it as one of the best 9 stocks to buy in 2025. Now, the reason Alphabet stock is as cheap as it is because of the risks from the changing consumer behavior to search queries in large language models. If you took that factor out and you just observed Alphabet's business, you looked at the returns on invested capital, you look at revenue growth rates, earnings growth rates, you look at cash flow, you look at the returns on assets, all of which would point to a company that deserves a forward price to earnings of 30 or above. But right now it's trading at 20 because of those risks. Investors are very concerned with those risks. And I think the devaluation as a result of those risks is overdone. I do believe there needs to be some margin of safety applied to Alphabet's business to account for those risks. But I think the margin of safety that's being applied right now is too much. And so I see Alphabet as an opportunity here. IBM, meanwhile, doesn't have the characteristics of a business that deserves a much higher valuation. It's not growing revenue anywhere near as quickly as Alphabet. Its return on invested capital are nowhere near the levels of Alphabet and probably will never be so.
Click the link below to watch the full video.